Hey everyone, Abaroa for Financial Intelligence Training. It is Friday, it is September 28th, and it is 2018, and that makes it a wrap for the month of September. If you know what that means in my house, that means next month is Halloween, so I have got to go in the attic and take down all the decorations so the kids can get ready and be excited for their barrels of candy to come. It also means that next Friday we have a fresh round of macroeconomic data. And this week we had our Q2 revisions leaving the number at 4.2%, which is a scotch above the previously estimated 4.1. A solid number, which hopefully will be accompanied by another solid number in next week's data. Now, financial intelligence training students certainly understand the importance of the macros and how to dress and redress the portfolio off of that data. Now, I've got no interest in talking up the news, but I'd be remiss to not at least mention the hearings yesterday. They were such big news that gave very little attention to the fact that Tesla and Elon Musk were sued by the SEC. Now, this is going to be a real battle for him, and it could substantially impact the future of his company. And with his potential, or his inability, I should say, to be at the helm of that company or any other publicly traded company. Well, while he's having a bad day and the investors of Tesla are having a bad day, I'll tell you who's not. The shorts and the attorneys. They're both popping champagne. This is going to be a very expensive ordeal for Mr. Musk. I hope he has his funding secured. Okay, enough of the not so funny humor, but let's talk markets, but not the current market. This week, I had two different conversations that really remind me of the need of investors to really understand what they are attempting to do within their portfolios. You see, in each instance, investors were not necessarily aware of why things were being done within their portfolio. Doesn't mean that things were being done bad, it just means they weren't sure why things were being done. So as an example, how much risk does the current mix of their holdings actually carry versus what they think that they are carrying? So I'd like to take a moment to point out a few important terms. The first is risk-adjusted return. So what does this mean? Simply put, how much risk are you accepting to seek that return within the portfolio? The second term that I want to come up with here, or explain, is really a combination of terms, and that's upside and downside capture. So let's start with upside capture. Let's say the market were to increase $1. Well, how much of that $1 did your portfolio increase by? Did it go up by 40 cents, 50 cents, 90 cents, or more than that dollar? So let's say it was 50 cents, meaning the market went up a buck and your portfolio increased by 50 cents. Well, you have captured 50% of the upside. Anything in excess of the benchmark would be deemed alpha, the rate captured above the benchmark, meaning the market went up by a buck and you made $1.10, 10 cents was your alpha. So let's look at the downside. Let's assume that the market dropped 10%, and it did this year. And now you look at your portfolio and you see that it dropped 11%. Well, in this case, the downside capture would be $1.10. In other words, every $1 that the market fell on this hypothetical portfolio, it fell by $1.10. Now, use the same metric of $1. If the hypothetical portfolio falls to just 50 cents, well, then your downside capture is 50%. The point here as it relates to risk-adjusted returns is simple. Look towards your portfolio and see how much you're earning in relation to the benchmark and how much you're risking in relation to the benchmark as a gauge of your risk-adjusted return. Now think about how any changes may be made on that portfolio as the environment shifts. Do we have a boost in the macros next week, or do we have a negative shift? In either case, how does your portfolio shift to that change in the environment? Or does it? Perhaps you're just going to be held hostage to your allocation percentages. See, do you know the answer to this? Well, if you don't, I suggest strongly that you get those answers. And this is exactly what is the message that I try to convey to the financial intelligence training students. Understanding exactly what you have. Not what you think it is, but what you know it is. Okay, so let's switch gears from portfolio management for a moment to trading, and let me remind you of an important fact that you know. Trading involves a substantial degree of risk. It's not suitable for all investors. If you're trading stocks or options, that's the same. If you look at charts like I do, please remember that the charts are not necessarily indicative of future results, so past performance not necessarily indicative of future results. I'm Abaroa for Financial Intelligence Training. Thanks for watching, everybody. Have a great weekend.